What a night. So the Greek vote went on till I think 2 a.m. Dramatic stuff. That was past the deadline, in a way. The deadline they were supposed to have, as part of the agreement, they were supposed to have passed it through Parliament by yesterday, not technically today, since it was 2 a.m. Though, to be fair, I don't think anyone was that bothered about that. I mean, that's pretty much details. So back to the trade. The idea, we were using the 15-minute chart, and I noticed a couple of errors in the video. I was talking about a 2-to-1 ratio, and no, a 3-to-1 ratio, and I said it only needs to win 1 in 3. Well, actually, it only needs to win 1 in 4. Because the 1 win would make you 3 profit, and the 3 losses would each be 1 loss, and they would balance. But again, it was all about jumping on that opportunity yesterday, getting that trade in. So I had to wait after the video to make the trade, and it worked out nicely. I actually switched a couple of times, so I'll just go through the thought process here, and then we'll have another lesson on Friday, which is I suppose tomorrow. So what happened? I'll zoom in a bit. So this was the time period. Here's where we left off yesterday. You remember, the thing was falling and falling. I mentioned the idea of, don't catch a falling knife, because the temptation here is, it's cheap, but you don't know how much cheaper it's going to get. Hence, the strategy yesterday was, I'm going to wait till the charts show me that this impulse has come to an end. Based on doing a quick review of the last few times this had happened, that this was a kind of good guide. So actually, I'm just going to mention 2 or 3 things and, not go on forever. So, point 1. When this was going on, I was aware that the levels in my head were maybe, here, 11,400, 500, and it had gone up to 560 in the morning. Okay, so the recent time when the market had tested on the downside, there was support here. So I was thinking, okay, 11,480 is a potential stopping point. When it was falling here. So 11,480 would be a potential stopping point. So you could have placed, or I could have placed, an order to buy at 11,480, which would have worked out very nicely. That actually got it, and you could have predicted it. I mean, that wasn't a random stopping point. That was a natural stopping point. What was the other potential point? Well, if the top was, say, 11,560, say, and the bottom was 11. Okay, so this was 417, and this is 567. So that's 150, the difference. So the midpoint would be, well, 75 plus 15, so around about 1500, because it's not exactly 67, they're not, so things tend to, there's a naturality in stopping in the middle. So if the two levels are this and this, so I can zoom in a bit now. So if my two levels were this and this, well then the midpoint is round about, I think, here. So again, you have, and that was also a recent high. So you can either treat where the candle actually stopped as your high or the top of that wick. There isn't a concrete correct answer. So essentially, there was a lot of reasons that this 11,480 to 1150 would be the bottom. But again, you can't actually predict. The strategy I was following was, I'm going to wait till price action shows me that the market is now thinking. And the thing here was, once it started to go up, and that's where I bought it. I bought it once at 11,497. I bought a half there. Then I made an error. I saw the price was going up, and I thought, uh-oh, I'm missing out. And that's the peril. So I bought another half here at 507, 11,507, because I didn't want to miss out. Then the market turned. Remember, this candle means this is how low the price fell. The candle is just where it opened and closed. But at some point it retested. It started going down and down and down. That's when I bought again. Because by the time this was happening, I'd done the analysis that I just talked about. I went, no, I'm happy that the 11,480 to 11,500 is where I feel that there is support. That's going to be my bottom. So with that in mind, I could safely put a stop loss at 11,475, say. And I think I did. And for the one that I bought at 11,486, I think it was, I put a stop loss 20 below, or 25, something like that. Since it was going to be a small stop loss, so that if I lost, I was only going to lose, a little bit. But my initial target was 11,560. That's the top there. But then once I placed those orders, and then I was happy to see that the market jumped up just as I bought the thing at a 486. I kind of went, no, this is a quick short-term trade. I'm not looking. I hadn't planned to make this trade. I don't plan on sitting on it. I will happily take 545. Because then I'll make like 60. I make 50 euro. Because I had a half. No, I bought one at 486. So I'll make 50 euro. Sorry, at 486. Yeah, I'll make 60 euro if I sell at 546, which is what I did. And I sold the one that I bought at 11,507, the half trade. I sold that at 508 or 510, just to get out of that trade, because that was a wrong trade. Because buying at 507 meant my stop loss was, say, at 77. So that meant I had a 30 loss, and I was only going to make 40 profit, which is not a great trade, which is not highly attractive. Now I had the position, I had one at 586. That was far, more attractive, because I was only risking, say, 25, and I was looking to make 60. That's the kind of trade you're looking for. As it turned out, the Parliament approved the bill, and it shot up. Now, of course, I could have not put a stop loss at a very small level, at a small profit, and could have aimed to hold on to it, but that would have been a longer term trade. I already have my positions from before, which I bought at a far lower level. I mean, that was the earlier video that I did. I think I bought it at, where was it? Yeah, something like 11,000. I mean, it was a good way back. So I'm holding on to that position. Yesterday's trade was just a quick opportunistic trade based on the charts, based on the fact that suddenly the markets had gone. Well, I suppose the markets were worrying about what's going to happen in the Greek Parliament. Are they not going to pass that? What's that going to mean? So there was suddenly a lot. That was the period of greatest uncertainty, and so the value would go down. Now it's jumped nicely. What do we think? What do we expect to happen next? Well, of course you can't predict the future, but there are a lot of bullish things for the DAX. Well, firstly, the euro has fallen to about 110. I don't know what it is at this moment. It might be 109. But primarily, the point is that the euro the last while has fallen a lot. And the DAX is priced in euros. So a lot of the up move here in the DAX is just due to the fact that it's priced in euros. And I've seen plots overlaying the euro movements with the DAX, and yeah, it's I mean, obviously, as the euro fell from maybe $147 to 109, that's like what, 30%, if not 40% drop. That's going to reflect with the stock market going up by 20, 30, 40%. So that's adds further boost to the stock market. On top of that, if the euro falls, or since the euro has fallen, it means that German goods are even more competitive. I mean, they were doing superbly well even when the euro was very high, but of course it helps if costs go down by 30%, so that when you're trying to export your goods, things should just fly off the shelf. So that should mean that German companies will, even if the price wasn't listed in euros, German companies should be doing very well. Hence, I'm happy to be buying the DAX. And there are multiple other reasons. And just in general, the feeling is, the recent economic figures from Europe have been turning around, because they'll all be experiencing the boost of having the weaker euro, which means that they'll all become suddenly far more competitive, and so essentially everything is lined up in my favour buying the euro, or buying the DAX. If I zoom back a bit, well, the thing is, the DAX is at all-time record highs. So, is it overbought? Are we in a bubble market? I'm just going to spend a minute or two just talking about that. So, here's the DAX since, what's the time scale? Okay, so since roughly, for the last 25 years. And we can see that there was a boost. I want to lower a bit so I can see that. Yeah, so here was the peak around about 2000, which would be the dot-com bubble, and then the market collapsed a minute. Oh, you mean companies should be making money, and you can't be worth many billions with no earnings? So that fell. Then this is the housing bubble, the free credit, and whatever explanation you want to give that one. That's the more recent 2008-ish. Well, actually, this is 2008 when the DAX fell. Now it's recovered, and I imagine when QE, the ECB, started printing money, that added a boost. I'm not sure. I'll have to look that up again. That might have been around about here. But looking at that, it does feel a bit top heavy. Because the basic mechanics are actually really simple. There's nothing. So it was at 2000. It shot up to 6,000-ish. Then it shot up to, well, not 8,000, 7,800. Not a nice round number, but it did touch up to 8,000. Fell back, went up, didn't fall back as much as it had after the dot-com. Shot up. It's just that, okay, basically what I'm saying is, my feeling here is that it is going to crash, and I need to be positioned for that. It's easy to be highly, and I am excited and delighted about the bullishness of the market. I am buying shares. I am highly leveraged buying shares. But look here, the RSI, there's this thing called negative divergence. So it's the level of excitement, enthusiasm, optimism in the market. So back here, it was crazy optimistic, but 90. So what happened then? 1997? I don't know. And it wasn't even a record. It didn't. That doesn't look like a crazy peak. But then it shot up, but it wasn't as excited. People weren't as optimistic. I mean, what you look for is this picture that the RSI is giving you, or the story the RSI is telling you, the same as what the price action is telling you. And in this case, it isn't. I mean, the market's going up, shooting up, which is saying, yay, great. But the RSI is saying, well, it's good, but the first movie was better. Or it's not as delighted. So if you go over here, now it's shot up to, at the time an all-time record high, and yet the market's not feeling it. It's not feeling great. It crashes down here. Now it shoots up, but it never gets as excited as it did in the previous up move. It crashes again. Now what is positive here is that it didn't fall below or even as low as the recent low. So that's a optimistic for bulls signal. Again, I don't know the answer. I'm trying to just see what is there without imposing my wishes or what I want. So it goes up here, boom, down here, blah blah blah. But look here, boom, which is not a technical term. So it shot up. But the RSI nowhere near, it's not near the peaks of back here. And also looking at it, the market, there's not irrational exuberance in the market. People are not going buy, oh, how great the stock market is. In general, it's more firefighting. So it's a weird market. It doesn't feel like an absolute bull market, everyone quitting their jobs to buy shares and all that kind of stuff. So what am I saying? Well, I'm thinking more in because you want to do this kind of monthly chart look once or twice a year maybe, just to see the bigger picture. So what's my feeling on the bigger picture this time? Well, firstly, as I said, these are very high levels. So I don't know, you don't want to be sitting there with loads of shares. You don't want to be really long the market, because I wouldn't be surprised if the market collapsed at least down to this level sometime. Another way to look at it is, okay, the peak here was 2000. The peak here was 2007. The peak here is 2015. So this market, so the gap between this and this was 7 years. Or yeah, it continued at this high level from 7 to 8 years. So this is now 7 years after the previous peak. So again, not sophisticated, not very quanty, but then it was that simple last time. I mean, so if it falls again, you'd be kicking yourself and going, oh, I didn't know. Well, it's exactly the same period as the last time. So it's hardly a surprise. So you just want to have I'm just building up a mental picture of the pros and cons, the signals that are out there telling you that the market's about to crash. That it could fall down to maybe 5,000 the next time. So in that case, I want to be short the market. When it falls, it tends to fall faster than it goes up. So at this stage, I suppose that's all I have to say. For the moment, I am long the market. I think that with the euro falling, I think it might fall another maybe 5%. That wouldn't surprise me at all, if not 10%. Because in a way, the market having come so close to parity, you kind of want to just touch it. Also, it has actually. Okay, I'll switch to away from the monthly to maybe the weekly chart to get a picture. So the market has been up to 12,400. So there shouldn't be much resistance till at least 12,000, maybe 12,400. So I'm willing to ride this wave. I'll start trimming my positions at 12,000, maybe 12,400, or do I expect it to jump one last hurrah, and in a blaze of glory, zoom past the record high, but you look back at that level and go, what was it doing up there? So for my immediate, with my short-term hat on, I'm thinking I'm happy to hold on to this, but I'm aware that very soon I want to become neutral. I want to get out of this trade, and I'm lowering my leverage level, because what you don't want to do, and what the market ends up typically doing, is you don't want to end up having the most shares when the price is at the peak level, because if the market is low, people go, oh, I'm not going to buy a share now. It's not. It's low. It's a poor investment. But it's when it's cheap that you want to buy it. You don't want to sit there and go, oh, it's gone up 80%. It's doubled. It's trebled. That's a great share. I'll buy that. But it's already trebled. You know what I mean? You're not buying it at a good price. You're not expecting it to double again. So once a share is at a high level, once in particular, I'd be looking at the RSI. I'd be looking to get out when the RSI is high. So if you look here, when the RSI was 70, that was a good time to get out. Again, this is RSI above 70. That was a good time. Well, in this case, it depends where you bought it, because it actually kept going up. But if you bought it when the RSI was low, so if you'd bought it here and then waited till the RSI was 70, you would have done well. Now, one last thing. This doesn't always work. In the 2007-8, that kind of period when the markets were crashing, you would just have gotten burnt. The markets kept flipping, and all the people who were trading on the basis of I'll buy when the RSI is low and I'll sell when it's high, that didn't work. So there isn't a magic formula that if you just apply, you'll be able to print money. Oh, well, it's a poor timing, because of course at the moment most of the central banks are printing money, but that's another thing. So, be aware of that. It isn't that the RSI is a magic formula. You've got to balance 3 or 4, if not more, things, and the trades you're going to make, you're not going to always win. So you have to, be level-headed, balanced, and look to win in the long term. As in, if making maybe 10 trades, you'll win some, you'll lose some. You want your wins to be larger than your losses, so that you can cover, so that you come up on top, so that you can absorb the losses. So that's all for today. Been an exciting last week. Not sure what to cover tomorrow, but there's so much to talk about. It's more a matter of, I don't know which thing to pick, as opposed to, I don't have anything to say. So that's just a part 2 update of the trade yesterday, which was worked out rather well. So I think I'll enjoy the weekend.